The price chart has two axes. The y-axis represents the spatial dimension of the market where we can see price fluctuations in terms of magnitude. The x-axis represents the temporal dimension in which price fluctuations occur. The combination of both axes enables us to see the fluctuations of price over time in an organized manner. However, when we look at price charts, we often get the impression that there is a hidden force driving the market, and we cannot really tell what this force is doing most of the time. We can only see its reflection on price volatility somehow. We call this hidden force the market momentum, which can be defined as the invisible market inertia or the net result of buyer power against seller power. The tricky thing about the impression of market momentum is that it can be misleading most of the time. For example, price might be rising ferociously without too much momentum behind it. On the other hand, price might display low levels of volatility with a significant degree of momentum behind it. The thing is that we can observe a synchrony between price action and its perceived momentum. There are two possibilities. Price can be coordinated or out of sync with its apparent momentum. This is where the idea of divergence was born. Since we have a few indicators to measure market momentum, we can see this discrepancy happening in a more tangible way. The classic technical indicator used to measure momentum is the relative strength index, which has the advantage of displaying the magnitude of market momentum independently from raw price action. Notice that we are not trying to smooth price action with the relative strength index. We are trying to create a visual representation of market momentum with it. That's in agreement with the Bonini's paradox that was outlined in previous lectures. Once again, we are not attempting to find a linear formula for the market momentum. We are simply trying to catch the moments where raw price action and its measurement of momentum seem to be out of sync by mathematical standards. That's the best we can do to measure market momentum. It is worthy of noticing that the relative strength index was attributed with some functions it is not capable of performing over the years due to the experimental nature of technical analysis. One example of this is the idea of overbought and oversold levels in the relative strength index, which is a too bold and ambitious idea to say the least. This indicator is built in a fixed scale, so it naturally produces distorted levels because it's trying to reflect price, which is not represented in a fixed scale. This idea of overbought and oversold levels is clearly bad because of this. However, the idea of divergence is a good one because we can take the relative strength index weakness and turn it into a useful tool. Divergence is a very common idea in the markets, and many traders give up on it because this idea by itself is useless, especially in the way it is usually presented in technical analysis manuals and so on. The idea of divergence is good, but it is hugely incomplete without the extra layer of fractal analysis and the understanding of how to perceive the different market flows. Just as a parenthesis, many traders commit the mistake to look for the all-powerful technique of the markets, and they inevitably end up being frustrated in their search. That's common in the markets because a lot of people have an inherent drive to find a quick and simple technique that will turn trading into an easy task. Traders with that kind of mindset are basically shooting themselves in the foot. By using a one-dimensional technique and expecting it to behave like a multi-layered tool, the trader is assuming this simple tool has a lot more power than what it actually has. This is a paradoxical behavior, and unfortunately, it is highly intuitive because we have cognitive biases that drive us to find the simplest solutions to our problems, which are not always considered to be the best solutions. Most traders don't like the idea that the markets are complex, so they immediately gravitate towards the notion that the smart thing to do is to keep things simple as far as the market analysis goes. Ironically, that behavior is the opposite of being smart about the market. Unfortunately, the market cannot be compressed down to the level of univariate tools. The variable that needs to adapt is the trader, not the market. In other words, the trader needs to adapt to the level of complexity of the markets instead of the market adapting to the level of simplicity of our primitive biases and need for cognitive comfort. Divergence is a popular technique, but since many traders insist in this unreliable mindset I've been describing, they never end up accessing the true power of this tool, and of many other tools for that matter. With that said, simple divergence by itself is a poor tool. We need to take this idea to the next level of complexity through the lens of fractal analysis and combine it with other good tools to form a good strategy. Divergence is just a way of visualizing the discrepancy or asymmetry between raw price action and its perceived momentum. Since we are going to explore this idea in its full potential, we are also going to analyze its weaknesses so you can have a good idea of the precautions you must have with it. Let's analyze a few conceptual examples to understand exactly how we can measure momentum and divergences by comparing the highs and lows in price action with the highs and lows in the relative strength index. First, we should point out that there are two modes in which price can be in. The fluctuations in price action can be coordinated with its perceived momentum or out of sync. When price and momentum are coordinated, price action creates a higher high or a lower low, and the relative strength index also produces a higher high or a lower low. That basically means that price is displaying the same amount of momentum that is being measured by the relative strength index. When price and momentum are out of sync, there are two distinct situations that can happen. The first and most common of them is called a reversal divergence. The second situation is called a hidden divergence. A reversal divergence when price is going up happens when price creates a higher high and the relative strength index creates a lower high. That basically means that price is going up, but it has a low amount of momentum sustaining this movement. If the divergence is legitimate and not simply a distortion in the way momentum is plotted on the chart, price will reverse after it. By the same token, when price is going down, a reversal divergence happens when price makes a lower low and the relative strength index makes a higher low. Needless to say, this works in the exact opposite way of an upward market. The hidden divergence is the opposite of the reversal divergence because instead of signaling a reversal, the hidden divergence signals a continuation in the overall movement of the market. In an upward movement, a hidden divergence occurs when price makes a higher low, and the relative strength index makes a lower low. The logic behind this is that the price seems to be reluctant to display the same amount of magnitude observed by the plotted momentum. In a downward movement, a hidden divergence occurs when price makes a lower high and the relative strength index makes a higher high. This is where most of the traders in the market stop learning about divergence. However, we are going to take these two types of divergence and we are going to layer them together in different fractals to see the results. As it was pointed out already a few times, the way to do that is by using the idea of fractal analysis, which is going to be explored in the next lecture.